Gold and silver prices have been moving up last few months, few weeks actually. Good momentum. Two big transactions, obviously, the Newmont and Gold Corp and Barrick Rand Gold. Obviously, the sector seems to be going in the right direction. But let's do a short, quick survey. Since we are a subset of the entire investing community, let's see who is actively buying now, who's not actively, or who's against the investing now, or who is in the middle. So by show of hands, who are actively investing these days? Okay, that's about 40%. Who are against investing, just kind of no investing at all? That's one gentleman out there. And I guess the middle, people in the middle are the ones watching.
For the best editorial on junior mining, visit cambridgehouse.com/mining. Click the link in the description below to learn more.
So let's, by show of hands, please, who are watching, who are cautious. So, great. So 40% is buying, 40% I would say, or 45% I would say is looking, just cautious. And just one gentleman that's like 1% is maybe not buying. We are in between middle and actively buying. We do believe 2019 will be a strong year. And I'm going to talk about why we believe 2019 will be a good year. But we are very cautious. We are highly selective on what we look at. And it's primarily because of the learning experiences we have had in the past. And by that I mean the failures we have had in the past. One of the classic examples of mine is the day after Fukushima accident. I just got into a lot of uranium stocks. And you all know what happened to that. I painfully that guy invested with me. That's why he's unhappy. So obviously, I remember those days very painfully. But what it taught me is to be very selective. Look at the management team. Look at a bunch of wide range of things to see what you like and just go along with it. And that's what we're doing these days. That's what I'm going to talk about in the next 15 minutes or so. I'm also going to talk about some of the valuations we see. And I'm also going to talk about some of the names that we like in each sector. As a big audience, you may have preference for different commodities. So I hope you find good names, some good names in the sector or commodities that you like. Before that, a quick look at the disclaimers.
For the best editorial on junior mining, visit cambridgehouse.com/mining. Click the link in the description below to learn more.
Please read this very, very fast. Okay, so let's see what happened in the past 12 months in terms of commodity prices. No doubt, cobalt was the biggest loser, 50% down. They were actually the biggest winner the year before. Then lithium is down 27%. Then you see the base metals. Then gold was down 5-6%. All this had one thing in common, and that was the US dollar was up 5%. So gold and US dollar had a almost positive or one-on-one correlation, negative correlation. And we think the strong performance of US dollar was the big reason why we had a relatively poor year last year. And that's why we think next year would be good, because we think the US dollar will depreciate in 2019. For that, I have 4 reasons why we believe so. Number one is GDP growth rate. This table by the IMF, it shows the GDP growth in the last 2 years, and also shows the forecast for next year. As you can see, the US, they're expecting the growth to decline from 2.9% to 2.5%. The global growth is expected to be flat. You see China is expected to grow from 6.6% last year to 6.2%. But what's the takeaway of all these things? This is what happened in 2018, the change in year-over-year growth rates. You can see here, the US was one of the best. All the other big economies were negative, which means the growth rates declined in those, for these countries in that year. The global growth was flat. Let's look at next year, 2019. the decline in growth rate of all the regions, US is a big negative, while we are expecting, or the IMF is expecting, the growth rates to increase in India, Russia, UK, and even China is better off than US in terms of the decline in growth rate. So number one is we expect the other economies to be relatively better off than the US. Number two is controlled inflation in US. Right now, inflation is 1.9%. It's controlled, which means that we may not see further rate hikes, or maybe not even a single rate hike this year in 2019. And that's significantly different from a lot of what the market says. The market is expecting a lot of rate hikes, but we don't think that's going to happen this year. The third reason is an inverted yield curve. What it shows is the difference in yield from a long-term treasury minus a shorter-term treasury. Typically, when there's an inverted yield curve, it means that we are heading into a slowdown. The reason because investors prefer longer-term treasuries and they don't like shorter-term. And that kind of implies that we may see a slowdown or maybe even a recession going forward in the US. So that's the third reason why we think the US dollar is going to decline. And the fourth and the final reason is the record stock valuations in the US market. Right now, price to earnings of the market in the US is 23 times. You see the chart here? 5 years ago, it was 15 times. So definitely we see a potential correction in the market, which could also affect the US dollar in general. So these four factors we think could impact the US dollar, and as a result, we think the commodities as a whole, across the board, should get a lift. Obviously, gold has a strong negative correlation, so I don't have to explain why we think gold should do well. But we don't expect any strong run in prices, which is kind of a reason why we are a little bit cautious. We do expect a good year, but not a strong run or a big run in commodity prices. So I talked about gold, why we think gold should do well. Silver, this is the reason why we think silver could be doing okay, and that's the gold to silver ratio. It's again at record highs at 85 times. Historical average is 55 times. Silver, demand comes from industrial plus its status as a safe haven slash capital preservation asset. So with the US dollar and with the gold, doing well, we think silver should have a good year. The next few slides, I'm just going to run through them. I'm not going to talk about each commodity in detail, but I'm just going to show the strongest points for each commodity. Copper, the best way really is to look at the inventory or the stock levels for each commodity. You can see that the copper inventory levels are at extremely low levels. That's at the top right corner. You can see the levels or the stock levels going down, and that should have a positive impact on copper. Zinc, again, same story. Stock levels are going down, and that should also again help zinc. With battery-related metals, that is cobalt, lithium, also graphite, I think these 3 points highlight why we should have a positive outlook or a long-term positive outlook on these commodities. Number one, I'm just going to read them up. So it's EVs grew by 54% to 3.1 million in 2017, and is expected to grow to 125 million by 2030. 55% of all new car sales and 33% of the global fleet will be electric by 2040. The upfront cost of EVs will become competitive starting 2024. All these three are very powerful, and we can see ourselves in our daily life why the EVs are getting traction and why we think these numbers could be possible. So how do we expose ourselves to this kind of growth? And that's, I think, through cobalt, lithium, and graphite stories. Cobalt, I just have one thing to say is, if there are 16 million vehicles, annual sales by 2025, that's the consensus forecast. Each car requires 10 kilograms of cobalt. So that means 16 million vehicles would need 110,000 tons of new cobalt demand. Right now, the demand for batteries from cobalt is just 50,000. So with this, the demand should be 50 plus another 110. That's 160,000 tons of cobalt. Where is that going to come from? Currently, we know over 50% of the demand, supply comes from the DRC, and all the companies are looking for safe, politically sound jurisdictions. And that's where cobalt plays in North America. We think is going to do significantly better than other regions. Lithium, similar story. You look at the number of electric vehicles that's going to be out there, and we think lithium, there should be another 217,000 tons of new lithium demand. The current demand for lithium from electric vehicles is just 20,000. So another 200,000 tons of new lithium has to be produced per year to meet the demand requirements. So that's all about commodities. Next few slides, I'm going to talk about some of the valuations we see in the space. Obviously, us being analysts, in order to evaluate a company, we do multiple models: a discounted cash flow model, a comparables model, even in some cases we do a real options model. But in this, I'm just going to talk about the comparables valuations, which all of us can do in just a few minutes of looking at each company. The best metric is the enterprise value to resource. Enterprise value, what it means really is what the market thinks the value of the company's assets are after removing cash and debt from the company. So the formula is enterprise value equals market cap plus debt minus cash. So if a market cap is 10 million, if the debt is 3 million, cash is 1 million, so 10 plus 3 minus 1, that's 12. That's what the market thinks the valuation of the company's assets are. Now you take that $12 million and divide that by the resource a company has. Look at the ratio, compare that with other companies in the space. You get an idea if a company is undervalued or overvalued. Now that's not the only metric that should be used, but it gives us a good starting point to do your due diligence. So these are the current metrics we see out there for using the enterprise value to resource number. I've shown gold and silver here. And as you can imagine, the ratios change as the regions change. So gold in Eastern Canada for juniors is $50 an ounce. That used to be $60 an ounce 6 months ago. Gold in Nevada is $36 an ounce. Nevada projects are valued lower because they tend to be of lower grades. And gold in Africa has the biggest discount, $27 an ounce. This number used to be $34 an ounce 6 months ago. So you can see how the valuations have declined in the past 6 months. Moving to silver, the gold juniors are trading at 84 cents per ounce. And the producers are at $1.79 per ounce. So these are very useful metrics for your due diligence purpose. And I can say that across the board, the metrics are down 20%. Moving to base metals and battery metals, you can see the numbers for each commodity. I would say take a picture of this or write this down because it's very useful for again, your due diligence. We update that on a regular basis. So you can see that copper is 3 pounds, zinc is 1 pound, cobalt 50 cents per pound, and you see lithium is $80 a ton. So that's what it is. So in the next few slides, I'm just going to run through some of the companies we like in each sector. So you don't have to focus on all. Look at the commodity that you like and focus on the companies that I mentioned in those commodity. First, starting with cobalt, I'm going to mention 2 names, which is Fortune Minerals. This is by far the largest primary cobalt junior in North America. They have advanced stage 2 feasibility studies done. And you can see the numbers there. Market cap is just $34 million. In addition to cobalt, they also have over 1 million ounces of gold. Second is Global Energy, very small company. They have projects in Australia and Canada. Both have a resource number. A catalyst for them is they're coming up with an updated resource this year. And they are looking at acquiring a project in Nevada, which is also a cobalt project. The third one is a cobalt/nickel company, one of the largest sulfide deposits in the world, nickel sulfide, cobalt sulfide. Again, advanced stage project. The market cap is just $11 million, and they hold $5 million of cobalt-27 shares, which means the market assigns them just $6 million for an advanced stage project like this. Moving on to lithium, I'm going to mention two names. Standard Lithium is an advanced stage company. They've partnered with big chemical/brine companies. They have a proprietary technology that allows them to extract lithium from brine that they're already producing. A recent prototype of their pilot plant produced battery-quality lithium carbonate, which is a very strong sign. Next company is Lake Resource, a junior Australian company, but they have projects in Argentina. Just came up with an initial resource estimate, huge resource estimate, 1 million tons indicated, 3.4 million tons inferred, and they are in one of the best locations in Argentina. So we think a lot of new catalysts for this company. Copper, I have two names, Trilogy Metals. We think it's one of the best copper companies you'll see, over 2% grades. The CEO is the founder of Nova Gold, advanced stage project. Only one challenge is they are in Ambler district. A road that connects to Ambler district is in the permitting stage. If that comes through, this is a strong story. Second is Quatera Resource, small copper junior, advanced stage in Nevada. Market cap is just $13 million. Just a few months ago, they sold their water rights for $6 million US, which means the enterprise value of this company is just $4 or $5 million, and market gives kind of zero value to any of these projects that they hold. Zinc, I have two names, Foran Mining. We think it's a strong acquisition target. They're close to Hut Base. Hut Base mines are getting shut down in that area, and we think Foran Mining with an advanced stage project like this could be a strong target. Cash cost is negative, which means revenues is less than the revenues from byproducts cover the operating cost. Second is Hannon Metals, small junior, quite unknown junior in Ireland. They have a resource estimate, and they are doing a resource expansion drill program. And we think a lot of catalysts is expected to come from them. They're just trading at 0.003 cents per zinc pound of resource they have. Gold, I have a few stories. Monarch Gold is a advanced stage company in Quebec. Number of projects. They just came up with a feasibility study, which is extremely attractive. And they also generate over $10 million in revenues from custom milling. Market cap, look at that, it's under 50 million. Alamos Gold owns 20% of the company, and we think this could be a strong acquisition target as well. Gran Colombia produces over 200,000 ounces of gold a year. Record year this year. They just announced a press release last week. Look at the valuations in the space. Enterprise value to revenue is 0.7. Enterprise value to EBITDA is 1.8. Gold companies tend to trade at 7 times EBITDA. So we think this is a strong story to be told. The last few stories are Dynacor Gold. And Dynacor is the largest toll processing facility in Peru. And they are a dividend flowing company. They generate 2.5%. And I have two silver stories, and I'm just going to take 30 seconds, and I'm going to get done with it. Kootenay Silver is trading at 17 cents per ounce, one of the best Mexican silver stories out there. They're coming up with a new project with the high-grade results that they're expecting soon. And the final story for the day is Gold Play Exploration. Brand new story. They are coming up with a new updated or initial resource estimate in the coming weeks. We think that's going to look good. Thank you so much for your time. Sorry, Hugh, for the delay. And enjoy the rest of your show. Thank you.